I'm Grant Walker. Welcome to Last Call for Tuesday, the 19th of May. I'll be back with Heads Up Wednesday morning, 10 a.m. To rural news, PGG Rights and Real Estate General Manager Peter Newbold says prices of farms on a per hectare basis remain as healthy as 12 months ago. He was commenting on the latest April Real Estate Institute sales figures, which show sales and value growth both slowing when compared with a month ago, but still buoyant compared with 12 months ago. Mr. Newbold says the problem facing agents is the reluctance of sellers to list properties for sale. He claims his firm has motivated buyers for all farm categories at a ratio of approximately 2 buyers for every listed property, suggesting unsatisfied market demand. The REINZ figures show per hectare values are holding up, including for dairy properties in Southland, where better quality properties are selling for between $41,000 and $46,000 a hectare. Canterbury, where farms are changing hands at between $50,000 and $56,000 a hectare, and Waikato, where the market for more sought-after dairy properties sits between $40,000 and $50,000 per hectare. REINZ figures confirm the median price of dairy farms fluctuated slightly in some areas, but generally reflected the overall New Zealand median of $38,802 per hectare, compared with $37,761 per hectare in March. There were 485 farm sales in the 3 months to the end of April 2015, compared with 425 farm sales for the 3 months ended March 2015, and 498 farm sales for the 3 months to the end of April 2014. There were 1,798 farms sold in the year to April 2015, 2.8% fewer than were sold in the year to 2014. The median price per hectare for all farms sold in the 3 months to April was $28,668, compared with $24,574 for the 3 months ended April 2014. The median price per hectare rose 2.5% in April compared to March. Highlights include reduced sales in Northland, resulting in a higher level of listings in parts of the region. Waikato region dairy and grazing properties values holding up. A lift in horticultural block sales in Bay of Plenty, where prices are equal to or above pre-PSA levels. Limited properties available in Hawke's Bay, steady activity on dry stock properties throughout the Taranaki, Whanganui, Manawatu and Wairarapa regions where local buyers dominate, shortage of listings in Canterbury and reduced sales, and better properties throughout Otago and Southland selling with lesser quality and outlying farms being harder to attract inquiry. Grazing properties accounted for the largest number of sales, with 39.6% share of all sales over the 3 months to April 2015. Dairy accounted for 20%, finishing properties 15.9%, and horticultural properties accounted for 15.1% of all sales. These four property types accounted for 90.5% of all sales. The median price for lifestyle blocks rose 8.3% from April 2014, and there was a lift of 37% in sale numbers over the year. To producer figures. Producer input and output prices fell in the first quarter, mainly reflecting lower fuel costs and weakness in prices of meat and dairy products. Prices received by producers, or the Output Producer Price Index, fell 0.9% in the first 3 months of the year for an annual decline of 2.5%. According to Statistics New Zealand, prices paid by producers, or input PPI, fell 1.1% in the quarter for an annual decline of 4%. The government statistician said the PPI figures confirm other data that shows inflation pressures were weak in the first quarter, with the exception of the construction industry. Falling petrol and diesel prices were the main contributor to a 0.3% decline in the CPI in the first quarter that resulted in an annual inflation rate of just 0.1%. The Reserve Bank moved to a tacit easing bias, dropping reference to the prospect of higher rates in the wake of the inflation data. Prices received by sheep, beef, cattle and grain farmers dropped 11% in the first quarter, reflecting drought in some regions and higher rates of slaughter. Prices received by dairy farmers dropped 4.6% as the Farmgate milk price fell further. Farmers' input costs, measured by the Farm Expenses Price Index, declined 0.5%, mainly on lower fuel prices. Prices paid by meat manufacturers fell 8.8% on lower prices for sheep and lamb, while prices they received fell 2.4% on lower prices for beef and sheep meat exports. Prices paid by dairy product manufacturers fell 3.3% on the decline in the Farmgate milk price, while prices they received dropped 5.2% on lower export prices for milk powder. Construction industry prices were higher. Prices received by construction companies rose 0.6% in the quarter, mainly on higher prices for building new houses, while prices paid by the industry fell 0.3% on lower fuel prices. The Capital Goods Price Index rose 0.6% in the first quarter, largely driven by the price of building houses, and was up 2.8% in the year. In the year ended in March quarter, newly built house prices rose 5%, while in Auckland they gained 5.9%. Prices received by electricity and gas companies rose 1.9% in the quarter, as lower lake levels drove up electricity prices.
NBR Radio, Tuesday the 19th. I'm John Stewart. Labour's Stuart Nash has hit out at the government's $7.45 million gift of a demonstration farm to the largest livestock trading company in Saudi Arabia. He says the deal lacks transparency. Our reporter Jamie Ball has been covering this story, and he joins me in the studio. So what else has Stuart Nash had to say in this blast? He talks about corporate welfare, I see, at one point, Jamie.
Yeah, Stuart's come in pretty strong on this, as you can expect. He actually wrote the foreword for the Taxpayers Union report on corporate welfare, but he's described this as corporate welfare at its worst. Perhaps the best quote from Stuart is, "What makes this deal even more difficult to swallow is the absolute lack of transparency surrounding exactly who has received how much money, for what and when, and if there is going to be any more of our money transferred to a Middle Eastern bank account." So really what we're talking about is at least $6 million has gone to Hamoud Ali Khalif of the Al Khalif Group in Saudi Arabia, but the same owners of NZ Awasi Holdings Limited here in Hawke's Bay.
Not easy there, Jamie.
No, it's not. Plus another 1.45 million to transport 900 ewes from Hawke's Bay to his farm in Saudi Arabia, of which 195 were actually bought from his farm in Hawke's Bay. So effectively, for those 195, New Zealand taxpayers, you and I, have paid to pick them up from Hawke's Bay and transport them over to his other farm in Saudi Arabia, with seemingly few questions asked as to what is the actual benefits, what are the tangible deliverables associated with this deal. How do you and I benefit from this?
Well, another point that Stuart Nash makes is he talks about the Hawke's Bay company that's been chosen to develop this demonstration farm because of its experience in the Middle East, but as claimed by the New Zealand Trade and Enterprise. But apparently that's not true.
Yeah, that's true. And I'd also admire Stuart on this one for calling out and calling it as it is, because he's a proud Hawke's Bay man, a Hawke's Bay family going back many generations. This does appear to be a Hawke's Bay deal presented as a New Zealand package. Now Brownrigg at the same time are a very reputable, very well thought of major agribusiness firm in New Zealand. I've had a lot of dealings with them over the years, and
But Nash is saying they've actually got no direct experience of working in the Middle East.
Well, sorry, that isn't actually Nash. No, that has to come out through my questioning of NZTE, by questioning them. They originally, for one of the reasons as to why Brownrigg was selected, they talked about their experience in the Middle East, but when I pushed this with Brownrigg, it actually is not the case. They've exported livestock and produce to the Middle East, but they've no actually direct working experience in the Middle East, which is really confounding. But there are many, many other reasons. Of course, we have to zoom out and look at the coincidence of two Hastings-based companies winning a national tender to work together, like in this manner. I've tried for the MFAT, the Ministry for Foreign Affairs and Trade, who coordinated that tender process, to try and find out who else was in the running, and try to get some sort of transparency around that, because it seems a remarkable coincidence that two companies a kilometre apart could end up working together like this. One of which is that is NZ Awasi Holdings, is a 25% stakeholder in Brownrigg. So from that perspective, it's a win-win situation for both Brownrigg and Awasi, and a lose-lose for the taxpayer.
So it looks like it's a fairly cosy relationship, and you're trying to throw some light on that.
I am trying to throw some light on it, but what needs to be said and emphasised is certainly Brownrigg, from what I can see, have done absolutely nothing wrong and have done nothing, not only just illegal, but nothing unethical. It's exactly as you'd expect any commercial company to operate as in that format. The questions are around how transparent that process, that tender process was, and now at this point how transparent the value of this farm is, and I think most crucially at this point is why can't NZTE confirm that no more taxpayer money is going to be plunged into this farm?
Very good question. Thanks very much for that, Jamie.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, I'm John Stewart. I'm here with Chris Hutching, our reporter in Christchurch, for our weekly Ask Me Anything segment. The person who will be answering those questions today is Andrew King, Executive Officer of the Property Investors Federation. Welcome to the show, Andrew.
Thank you.
Okay, now our first question today concerns the government's major changes to property tax rules, which came out on Sunday via Prime Minister John Key. He also announced there will be $29 million in extra funding for IRD to enforce them. So what do you make of that, Andrew?
Well, it does come out of the blue a little bit, and it is, although it is actually aimed at rental property investors, I guess, or investment property, the real aim, I think, of the policy change is for traders and speculators. I think a lot of people are concerned by the activity of people buying and selling houses and not paying their fair share of tax, and also keeping first-time buyers out of the market. And this would appear to be aimed at them in order to try and reduce the number of them. But it doesn't really, at the moment anyway, it doesn't appear that it's going to be too much of an effect on rental property owners, because most rental property owners own the property for more than 2 years, and so they're unlikely to come under that. But there is a clear distinction to be made here between what is an investor and what is a trader or a speculator. A trader and speculator trades properties, buys them to either do them up or just sell them on for a profit. Usually they want to do that as fast as they possibly can, and they must pay tax on any profit they make. It's counted as income. Whereas an investor is someone who provides a property to a tenant, usually for the long term, or hopefully for the long term, and they're treated differently. So they're different classes of investor.
So, Chris, any observations on that?
Well, yes, I think I go along largely with what Andrew's saying. It strikes me that those moves that were announced were political moves, really, designed to show New Zealanders that this government is interested, does care, and is not quite as laissez-faire as John Key may have made out in the recent past by claiming there was no housing bubble. Clearly, enough New Zealanders think that there is a housing bubble for the national government to feel safe about at least making noises about it.
Right. Now, another question from a verified but unnamed NBR reader. He or she says, on Monday, John Key said his government knows some property investors are rorting the system because, quote, in Budget 2010, we gave IRD $33 million more to hire inspectors. They've raised $250 million from people rorting the system. Do you accept, Andrew, that property investors have brought the crackdown on themselves through trying to rort the system?
No, I think this comes back again to differentiation and people getting mistaking investors for traders or speculators. It's traders and speculators, people who are buying with the intent of selling and flicking it quickly for a profit. They're the ones that are actually rorting the system, not investors. So an investor, again, is someone who buys a property with the intent of providing it as a home for a tenant. So they are not rorting the system. It is people who are buying and selling. They're two totally different types of investor.
Indeed.
But John, Andrew, I beg your pardon, Chris Hutching here, just how much influence or effect do these traders and speculators really have? I mean, the kind of price rises that we've seen in the past 12 months. I think it was 12% over 6 months, wasn't it? We've seen price rises in Auckland. So just, how much are these evil speculators and traders responsible for this, or are there other factors to play?
Oh, there's definitely other factors to play. We don't know whether this will have an effect on house prices at all, because we actually don't know how many traders or speculators there are actually out there. If there are lots, as a lot of people think there are, then this will have an effect. If there aren't as many as people think there are, then it won't. But we don't have the stats to be able to actually say it. My personal feeling is that it probably won't have much of an effect. I think that the main reason we're seeing house prices over the last couple of years, especially in Auckland, is because we've got 56,000 more people here than we did last year, and that's the real reason for it. A lot of people are saying it's rental property owners who are in the market as well in high numbers, but they're only the number of sales to rental property owners is about what you would expect. We own around about 33% of New Zealand's housing stock, so you would expect that at any given time we would be around about 35% of the turnover. At the moment, I think it's some have said that it's around about a third. Some have said it's more like 40%, but it's approximately what you would expect. So I don't think it's rental property owners who are doing it. I think it's more that we've got 56,000 more people here now than we did last year, and that's the key reason for it.
So is this thing mainly pinned to immigration numbers coming in? Now, I want to ask you a slightly curly question.
It is immigration numbers. Sorry to interrupt. It is immigration numbers, but it's also Kiwis coming back home, and it's also usually there's a number of New Zealanders who leave the country seeking jobs in Australia or elsewhere in other countries. And they don't seem to be leaving at the moment because we've got a reasonable economy and reasonable employment. So there's a combination of those three factors as to why the population is increasing.
So, Andrew, do you have any insights as to why this exact same phenomenon is happening in Australia?
No, not in Australia. I'm certainly no expert in Australia, but so no, I wouldn't have a clue, sorry.
Because we have seen some figures recently that suggest that overseas buyers are fueling the market in terms of new builds to the tune of 15 to 20% in some of the eastern states of Australia.
Well, that could well be true, and that could be true for New Zealand as well. And I think that's going back to the first question we received, actually, about the changes that John Key announced on Sunday. The one about making it easier for the IRD to actually track these people, or foreigners, who are buying here. I think that's a really good thing, because we've always said that there shouldn't be a law against them until we know if there is actually a problem. And I think this is the first step of identifying whether there is a problem or not. If there is, then we think government does have a role to play in fixing that. But until they actually know for certain, and there's a lot of speculation, but until the data is actually in and we know, that's when I think the law changes should occur.
Now, another question from an unnamed NBR reader. Investment in the Auckland residential property market can't possibly stack up unless the investor is banking on eventually realising tax-free capital gains. At current prices, the yields are just too low for anything else to be possible. Surely you can't argue with that, Andrew?
No, of course we can. I mean, it's a ridiculous argument, actually. At the moment, it's intent. What is your intent? Do you intend to trade in property? If you do, then you pay capital gains tax. If you don't, if you're providing it for a rental property, then you're an investor and there is no capital gains tax. The law says nothing about whether it's a good investment or not, or what the yield is, or anything like that. So at the moment, there's nothing which says that a capital gains tax should apply simply because the yield's too low. And if you think about other investments, people who make this argument, they're often rather myopic in their view. I think they just want to slam rental property, to be honest. What they're failing to think about is people who invest in companies like Xero. Xero hasn't made any money. It's made losses, actually. it doesn't provide any dividends. Why are you investing in that? So I think if there's lots of companies who do not make any money in the first few years of operation. 42 Below Zero was a classic one. Never made any money until it sold for hundreds of millions of dollars, which it paid no capital gains tax on. So if people are going to use this argument that, if your yield's too low, then we're going to have to either have a capital gains tax, or we're going to have to assume that you should be making this amount of money and we're going to tax you on that either, then it has to apply to everything, not just rental property. And I think that's where a lot of the people who are aggressively attacking rental property need to realise and look at this in a much bigger way. And they also need to realise that if they are in fact going to attack rental property owners for whatever reason they want to, then the customers of us are tenants. They are going to hurt tenants along the line. And I think people just need to take a much bigger, broader look at this and take away some of the emotion. They obviously don't like us as a investment proposition. They're attacking us constantly, but a lot of it just doesn't stack up.
Andrew, I wonder if you could clarify or comment on something that I've often pondered, and this is this low yield thing. Mm-hmm. I've often thought to myself, well, yes, why would it really matter too much if your yield is low at around bank levels or even lower when you have, say you have a good product, a good house, someone else is paying off your mortgage over time. So to that extent, that is its own reward, isn't it?
Well, it can be. I mean, some people have interest-only loans, and so they may not actually follow that investment strategy. But it does still. Generally, what's happening is that in the early stages, the yield is low, and you do have to actually prop up the property. The closer you can get it to being cash flow neutral when you buy it, or even better, make it cash flow positive when you buy it. It's not easy, but it's possible. The closer you get to that, then the sooner you actually start making cash flow profits from it, and you're not really having to worry about capital gain. Capital gain becomes the icing on the cake. It's still a factor. I mean, there's nothing wrong with a rental property owner thinking, right, I'm going to get some capital gain in this, and making that part of their investment decision. There's nothing wrong with that at all. But the closer they can get to cash flow neutral or positive when they first buy the property, then the sooner they're actually going to get to profit. It also means that they can actually buy more rental property if they want to. The kind of people, I think, who get heavily negatively geared from the very beginning, they may struggle to actually start making it cash flow positive before a number of years. And they're also putting themselves at risk because they're borrowing so much. And the third thing is that they often will it just won't make a very good investment. So usually these type of people don't do very well, actually. They should come along to the Property Investors Association and learn how to do it properly.
And now, Andrew, a couple of different questions from unnamed NBR readers, but they're both along very similar lines, so I'll throw them together. One asks, is there a negative perception of foreign investment? And the other one says, perhaps more broadly, does xenophobia exist in New Zealand? So what's your response to that whole perception of foreigners buying up our houses?
Look, potentially it does. But I mean, I've lived in a few different places around the world, and I think xenophobia seems to be everywhere, to be honest. Maybe it's just a human trait, I'm not too sure.
Yeah.
But it does seem that that is the case, and it is potentially fueled a bit by some of the media. I know whenever we see articles on TV about foreign buyers, and it'll go to an auction place, and it'll have snapshots of Asian faces in the crowd. But last night there was one which did a broadband sweep of an auction room, and by far 90% of the people there looked extraordinarily New Zealand to me. So it may be that it's being fueled, but then again, we just don't know. And this is where it comes back to the fact that we need decent information so that, or not, we don't, the government does. Government needs decent information so that it's making sound decisions and making laws if it is needed, and not just doing it on the whim of what people believe things or perceive things to be.
Any observations, Chris?
Well, Andrew, if it is not, if the driver is not this 56,000 people who immigrated here, albeit some of them will be Kiwis, what is it? Is it people just irrational exuberance? Is it like the run-up to the 87 crash or the 2008 crash?
I don't know if it's exuberance. It's pressure to own a house. Basically, you've got lots of people here who are trying to buy houses. We're not building them fast enough. And so if you've got two people and they want the same house, one of them is going to have more money and they're going to keep building up until they get it.
Given those numbers, though, sorry, John. Given those numbers of immigrants, though, wouldn't it be, pretty fair assumption that they're playing a very big part in it, even though we don't want to get xenophobic and start picking on small groups?
Potentially, but we don't know the number of foreigners who are coming into the country hasn't actually changed so much over the last 5 years. What has changed is the number of Kiwis returning home in the last couple of years. And the number of Kiwis not departing overseas. So we're not sure exactly that it's foreigners who are coming in and causing the problem. It may not be. What's his name? Tony Alexander from BNZ. He did a fairly loose study, I must say, but he did do a little bit of investigation into it and found that foreigners weren't a large part of the market. But as I say, it wasn't a particularly scientific study. And it may be wrong. And it also may be changing over time as well. It may be becoming more of a problem. So I'm not trying to say that foreigners are not part of the problem. I'm trying to say that we don't actually know. And now that the government are actually looking into it more to find out if it is truly a problem or not and if it's changing in any way, and therefore if they can see that and do something about it, then I think that's a good thing.
Now, to bring you up to date, we are talking to Andrew King, who's Executive Officer of the Property Investors Federation, and I'm joined by our property reporter in Christchurch, Chris Hutching, for our weekly Ask Me Anything slot, which Andrew is the subject of today. Now, Andrew, another question from a reader who goes by the name of Amanda Palmer, and it's about your organisation. Who do you speak for? How many property investors are there in New Zealand, ballpark, and how many belong to your organisation? Do you accept both local and foreign investors? Thanks.
That's a good question. Thank you, Amanda. Our members, there are 20 associations around the country. Our members are primarily residential property investors, although around about 15% of them own some form of commercial investment as well. We have around about 6,000 or 7,000 members. That's not many, unfortunately, of the approximately 250,000 rental property owners in New Zealand. So there's around about 7 or 8% of the population actually own rental property in New Zealand. I think a lot of people are surprised by that. They think everybody is getting into rental property. But it's not actually the case. More people own shares in businesses, particularly shares through fund management and KiwiSaver and things like that, as well as direct. So, yeah, quite a bit different.
Indeed. Now, another question from somebody who calls themselves an IRD Wanderer. So it says, Andrew King, you represent a class of investor who by large doesn't pay tax, and there is excellent factual support for this assertion. He says that's below. I won't read out that long list, but he says, I would be, presuming it's a he, I would be interested in your comments on tax avoidance by property investors.
I don't know where he got his factual support from. I don't think there's any factual support. We do pay tax. The tax inquiry that was held a couple of years ago, they poured out some IRD information that in 2008 we made net losses of around about 500 million. But that was in 2008 when interest rates were at their very highest. Their own report, which actually went back some 25 years, I think it was, showed that in that 25-year period, there was actually only 2 years when rental property owners were not net taxpayers. Right now, we pay tax on, I think it's $1.3 billion worth of rental income. So I'm afraid, IRD Wanderer, you're wrong. We do pay tax. We also support a lot of industries, and like property management companies, the councils, the insurance companies, the banks. So we do a lot for the economy. We are part of the productive sector. I think people who try and claim that rental property is not part of the productive sector are again myopic. They're trying to look for ways that do it, but we are definitely part of the productive sector. It'd be very hard to imagine a worker being very productive if they didn't have a good place to live. And that's what we do. There's all sorts of ways that companies contribute to the economy. Hairdressers, bankers, lots and lots of people who sell second-hand cars. They all contribute to the economy, and we are no different. We're part of the productive economy too.
Andrew, with regard to the capital gains tax that's supposedly coming in, have you made any inquiries about what happens if, say, somebody buys a property, investment property, say the market goes down or their circumstances change, whatever, they have to sell it at a loss? Have you made any inquiries as to whether or not they can make a claim under this new capital gains tax for that loss?
We're just looking at having a meeting with Todd McClay, the Minister of Revenue, just to clarify a few points about the change as well, and that'll definitely be one of them. It does seem rather unfair that if you do lose your job and you can suddenly no longer afford that property that you bought 6 months earlier, or if you're diagnosed with a terminal illness and again you need to sell that property, it seems harsh that you would have to pay a capital gains tax on any gain that you may have made, whereas if you're in another type of investment, like if you made money on the share market or a business or something like that, then you wouldn't have to pay that capital gains tax. So it does seem fair that it's extended, and there are some situations where it would seem fair to not have to pay that tax. They've already identified a couple, and that if you have a marriage breakup, then anything in the settlement won't be included in the tax. If a property has to be sold as part of the settlement, that won't be taxed. So as long as they've got things like that, then maybe we just think they should expand it a little bit, just so that it's a little bit fairer for somebody who's going through hard times for reasons not of their own doing.
Now, the next question from our readers is from one called Kaiser Souza. And he or she asks, Mr. King, you have here and on other forums repeated that there is no house price bubble, but that Auckland's dramatic increase in house prices is primarily due to increased immigration and supply imbalances. You'd stand by that, Andrew?
Yes, I would.
For what reasons?
Well, I guess it comes down to a definition. To me, a bubble is something where all the fundamentals have got out of kilter, and it's on the brink of falling and actually collapsing. And at the moment, I just don't see that we're in that position. I think the market is functioning exactly as you would have expected it to. It's done the same thing in many different property cycles, and for similar reasons too. In the last cycle, we had I think it was 34,000 extra people coming into the country, roughly. Around 2003, 4, 5, and the market didn't actually go up it went up faster than it has in this cycle, and yet we've had 56,000 people coming in. Also, things like the Massey University Affordability Index, we haven't reached the peak that we did back in 2007 in the previous cycle. So affordability, although it's difficult now because house prices have gone up. Well, it's difficult in Auckland because house prices have gone up. It's not as hard as it has been in the past. So when you look at things like that, we have actually got a bit of a way to go, I feel, until we can call it a bubble. I actually thought that back in 2007, we did have a bit of a bubble, and it was primed to burst. And I think I said that at the time. So if things are bubble-like, I'm certainly not averse to saying that they are. I think we have quite strong growth, or we do. We have very strong growth at the moment, but I just don't see it as being bubble-like at the moment. It's certainly not, when you talk about a bubble, it's something that's akin to about to burst, and this just doesn't feel like it at all. I think we've got a couple of years to go, if anything.
So, Chris, where do you stand on the bubble theory?
Well, I think I'd agree with Andrew to a large extent. I was trying to think back of times in recent history, or even in the last 3 to 4 decades, when houses overall have crashed. I don't think we could even say that 07, 08 was exactly a crash. Certainly things flatlined a bit and would have gone down in some areas. And we do have this disparity between Auckland and Christchurch and the rest of the country. There's no doubt about that. In some places, some regional places, prices are not creeping up at all. But I'm interested to hear Andrew say, this one could have a couple of years to run, because that does suggest to me that although he's saying, we haven't got a bubble right now, he can foresee that, we're entering bubble territory, and I just wonder what factors he thinks might prick that bubble, or if not prick the bubble, see us flatlining again like we did after 2008.
Well, I think we will flatline at some point. We've gone through these cycles many, many times before, and so we will at least flatline. The house price growth can't go on, and it will level out. Whether it becomes a bubble or not, I can see house prices going up for a couple of years. Maybe not as strong as they have done over the last year, but still going up. If they do go up at too fast a rate, then potentially you could start getting into bubble territory. And if it did, we did have a situation such as the economy falters, and all of a sudden the Kiwis who are coming home perhaps lose their job and they go back overseas again. And the ones who were staying home because the conditions were good, they decide that they might have a look overseas and see if they can get a job over there. If they suddenly leave and all of a sudden we've got negative population growth, but we've built a whole heap of houses in that 2-year period, and a lot of people have borrowed a lot of money and perhaps overdone it, then potentially you could have... it's unlikely to say a crash. I wouldn't say a crash, but you certainly could see prices fall because of that, things like that.
Now, the next question from, again, an unnamed NBR reader, but it's very direct, Andrew. How many investment properties do you own yourself, and how much tax have you paid on them? Pretty direct.
That is pretty direct. Look, I'm not going to answer that. I don't think that's particularly relevant at all.
I thought you might say that.
Yeah, I've got a few. I have bought and I have sold a couple, not many. But I have sold some, one to get into a business, and one when I was much younger and perhaps foolishly to fund an overseas trip. But I pay tax. I have some properties. I've been involved since how many years? Nearly 30 years. I've been involved in the industry. So that's sort of my background.
Sure. Now, one final question from, again, an unnamed reader. Labour, the Greens and New Zealand First have said variously that foreign property buyers should be subject to a surcharge and or only allowed to invest if they build a new home rather than buy an existing one. What's your opinion of those policies?
Foreign buyers coming in here, not only do they compete against first-home buyers, they do compete with rental property investors as well. So I'm certainly not a cheerleader for foreign buyers coming in. Having said that, I think if we need to watch the type of laws we do inflict upon them. If we do say that they need to, because we've got a shortage of building at the moment, it would seem prudent that we put in a law that says if you want to come to this country, you have to build a new house. Australia have done it, and so we can say, look, another country's done it as well. The thing that concerns me about that is that this could be a temporary measure, and we could have a long-term law in place which says that. And if we did get to the position where we actually built too many houses and then the population started decreasing because net migration is going out rather than coming in, we could have a situation where we've actually got too many houses in New Zealand, but we've got a law that says that anybody coming into the country has to build more. And so then we could turn around and say, these damn foreigners, they're doing it again. They're building houses when we don't want them. So I think we have to be careful about the laws that we bring in. And again, I'm not too sure if it's fair. If someone's coming here to live and they're genuinely going to move here to live and contribute to our society, I'm not too sure if it's fair and reasonable that we put any extra tax on them just because they've come from an overseas country.
Well, gentlemen, we'll have to wrap it up there, but thank you very much, Andrew King, and thanks also to Chris Hutching in Christchurch.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
In People News, a former Rockfort finance director has been released from prison less than 18 months into his sentence. Nigel O'Leary, 58, was convicted and sentenced to 4 years jail after pleading guilty to 9 charges in late October 2013, which led to investors losing $3.8 million. His convictions were for theft by a person in a special relationship, obtaining by deception, false statement by promoting and false accounting, all arising from the failure of Rockfort Finance. Mr O'Leary, whose sentence was due to end in late October 2017, has vowed to never return to finance despite being offered employment by an overseas company. The company of the investor and its country has been withheld. Mr O'Leary told the parole board, chaired by Justice Marion Frater, his offending was not just a case of bad decisions, but of continued deliberate fraudulent decisions. He said he was motivated by greed, selfishness, and the need to generate income to support the comfortable lifestyle to which he had become accustomed. The SFO had alleged that a significant portion of investor money was used to fund the director's personal business interests in Gisborne Haulage and Michael Ward 1969, which operated the Jeans Jones label before the chain was sold by its receivers. Investors' losses amounted to $3.8 million. In business news, New Zealand's largest commercial interior fit-out company has been tipped into liquidation by its shareholders. Last Thursday, after a shareholder special resolution, liquidators McDonald Vague were appointed to shares in MAC, which specialises in retail, hospitality and commercial fit-outs. Its shares are owned through a trust associated with law firm Claymore Partners, company's office records show. Liquidator Jared Booth says McDonald Vague is in the process of realising the company's assets and is seeking to sell the business as a going concern. He expects a distribution will be paid to creditors but declined to comment further. The company's website says it employs more than 110 full-time employees across Australasia, including designers, engineers, programmers, quantity surveyors, machine operators, builders and specialist painters. Its website says that for more than 25 years, Shares and Mac has managed commercial interior fit-outs from inception to conclusion. The company has recently moved into new 8,000 square metres in Penrose, Auckland, where it has invested in machinery and production facilities. Shares and Mac boasts a number of big-name clients, including Fisher & Paykel, Hallensteins, Glassons, Rod & Gunn, JR Duty Free, Louis Vuitton, New Zealand Cricket, Sass & Bide, Smith & Coeys and Vodafone. Company's office records show directors Gregory Barclay of Claymore Partners, Jeremy Byrne and Matthew Turnbull all resigned in the past month. Its remaining director, Craig Wilson, and company management could not be reached for comment, and NBR Radio understands a meeting to discuss the liquidation is being held today. In business news, Infratil has set itself the challenge of finding additional investments to build its portfolio at a time when it's awash with cash and when some asset values are overinflated. As well as looking for new opportunities, the company is reducing its unused debt facilities as well as returning cash to shareholders. The infrastructure investors' planned capital spending this year is forecast to fall to between $160 to $190 million, compared with $507.6 million in the year ended March. The company is forecasting earnings before interest, tax, depreciation and the costs of financial instruments from its existing investments will rise by between 15 to 21% this year to between $520 to $550 million, after a 3.7% increase in the year just gone. The increase reflects full-year contributions from Trustpower's investments in the Snowtown 11 wind farms and Green State Power, Wellington International Airport's expected increase in landing charges and passenger growth, and a full year's contribution from its $204 million investment in Retire Australia. But Chief Executive Marko Bogoevsky told investors, analysts and journalists the projected increase in earnings isn't enough and that his team needs to find new growth platforms to invest in to provide for longer-term growth. Mr. Bogoevsky says the most likely opportunities are in the retirement village and renewable energy sectors, although a number of existing investments, including Trustpower and Wellington International Airport, have further investment plans.
NBR Radio. With the Property Press. It's out now to show you around.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. John Banks acquitted over electoral returns, so will he run for mayor? The Crown to appeal .com's asset release. Rural property prices holding despite dairy downturn. Infratil's results and possible new investment approach. And Auckland Interior Design Company goes under. To find out more on these stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio.
NBR Radio, Tuesday the 16th. I'm John Stewart. And I'm joined for Property Talk by Chris Hutching on the line from Christchurch. And here in the studio in Auckland with me is Sally Lindsay. Now, Sally, can you first talk to us about an apartment which has produced a surprisingly low yield?
This was in Grafton, and the apartment is on top of two commercial properties. And apparently the previous owner had done it up to a very, very good state. So when people went round to look at the property, they noticed the apartment more than the commercial shops. And while it hadn't been rented out, the agent selling it got an indication of the rent it would yield, and it was about $800 a week. And they thought the buyers had priced that in separately to the other two commercial premises on the bottom, which were only returning $45,000 a year in rent. So when it came to the auction, it went berserk. There were 40 buyers there.
Good heavens. And
they priced in that apartment, because it's very, very posh apparently, and came up with a $2.5 million price for the whole property, which is unusual. And there were 8,000 people looking at it on the website, where in fact usually you only get 50 to 100 people looking at commercial properties. And 250 people turned up to the open homes, which is quite unusual on top of a commercial premises. But as the agent says, this is like gold, this property in Auckland. You don't get them very often. And someone had the foresight to do this up this two-bedroom apartment, and they've reaped the benefit from it.
But are they local owners?
Yes, apparently they're a family trust.
Right.
Maybe associated with one of the commercial premises below.
Now, Chris, to you next, and you've got some news for us about Tony Quinn, the racing car enthusiast, and Rich Lister. Tell us more.
Yes, Tony is an interesting character, Scottish-born. He's I suppose we call him a racing car entrepreneur. He has just purchased the Hampton Downs circuit near Tikawara for 15 mil, and he says he's going to spend another 25. I mean, these guys talk big numbers, but even if we pull them back a little bit, it's obviously a sizable investment.
Yeah.
And he's going to develop more business facilities around it, such as a business park. I think there are some apartments already on the go as well, which have got nice views of the racetrack. So motorheads can go there, and they can stay in their apartment for the weekend, and they can watch these races from their apartment. Pretty bizarre, eh?
Yeah.
And he's also done something else in Queenstown. He's set up a go-kart facility there at Remarkables Park, which is near the airport, and that's a $7 million venture.
Wow.
It's an indoor thingy for families. They can go along there, and you can go up ramps and tunnels and all sorts of things like that. And that's going to be part of a wider entertainment precinct that the developer of Remarkables Park, the Porter Group, is putting together.
Right.
Hampton Downs Park is quite amazing. You drive past it on the main road down to Hamilton, and there are always people there racing cars.
Really?
And there's actually a lot of apartments there already, and they're all fully occupied.
Sounds like quite a sensible investment decision.
Yes, it's very. It's a very busy one, and it's a bit of a feather in his cap. He does have another one called Highlands at Cromwell, which is very popular. It gets a lot of tourist traffic through it. The same sort of thing, family entertainment. He has got his eye on another one at Taupo, but there's a few problems there. The shareholders aren't too willing to sell it to him at the moment.
Now, this Porter Group you mentioned in passing on the outskirts of Queenstown, I think near the airport.
Yes.
It's they. Is it they who you were talking about last week who are planning have offered to build a convention centre there.
Yes, that's the case, and it's in the same area, the same sort of large precinct called Remarkables Park, where they want to do this. And the council are a bit miffed about this because, as we discussed last week, they've got their own plans for one in the middle of town. But the Porter Group is saying, look, we don't want any taxpayer money. We'll do it. We'll do it for Queenstown. Well, they're obviously going to do it for themselves as well. But there we go. So they're about to lodge a resource consents for that, and it'll be very interesting to see how it's opposed.
Just before we go off the subject, where's this Tony Quinn based?
Tony is... he gets around a lot. Right. Whenever I ring him, he's in Australia, where he's also got racing car interests. He's got a circuit over there as well. So he comes to New Zealand. I think he's in New Zealand for the coming month or two. Right. He told me that he had dual nationality. He's also got properties in the United States. So he's a busy boy. He gets about. He
certainly is. Now, Sally, you've been investigating Century 21, who are big-time real estate agents.
They are. A guy called Charles Darby, originally from Lebanon, owns it, or he was born in Australia, but his parents are Lebanese. Right. He owns all the franchises throughout Australia and New Zealand, which is quite an achievement.
How many would that be?
That's 300 franchises. So I had breakfast with him on Saturday morning. He was over here to hand out awards for his top agents, which is a regular occurrence in these agencies these days. And he had some interesting things to say about the property market, Sydney compared to Auckland, which he reckons both are very similar.
Oh, really?
And the house prices are going up at pretty much the same rate. The same pet things attract people to houses in both of these markets, and he doesn't see the house price fiasco not stopping. He says it's going to carry on. And
so we're not talking about bubbles bursting?
No,
then.
He says there's no bubbles. It's just purely a supply and demand issue, and he said a lot of it is pent up after the GFC, and no one invested any money or developed anything, and people are now they're letting in immigration into both countries, although it's a lot easier to get into New Zealand than it is in Australia. But still, they have their problems with immigration as well. And one of the banks in New South Wales did a survey and found that 21% of people applying for money were foreign to buy houses. In New Zealand, we have no figures on that, but anecdotally it's about 10%. And he said the sort of most interesting thing is that really a lot of the market is driven by hype. People panicking because everyone's talking about it, panicking that they're not in the market, they don't own a house, and then it's all self-fulfilling.
Yeah, it's the old role of sentiment and matters of money.
Exactly.
Yeah. So
and we have to keep in mind that Charles, of course, is a part of that fueling of that bubble because that's his business. So I'll keep the number next to my desk, and when the bubble bursts, I'll give him a buzz and ask him what he thinks is going on.
He did say that he did temper that with saying that you should not go into the housing market just for the sake of it. He said that's the wrong decision.
Now, Chris, finally and briefly, you've been having a look at retirement villages.
Well, this is based on another study that Jones Lang LaSalle's researchers did, and they just had a look at the ageing population and cracked a few numbers, and basically came at the conclusion that there's heaps of opportunity there for providers of retirement villages yet, because there has been some talk in the market, how many villages can you build? We've got, big players, Ryman, Bupa, Somerset, that sort of person. Probably one of the interesting things which came out of it, the way that there are some slight dynamics changing. People are going into these retirement homes at an older age, less likely to go in until their 70s rather than late 60s, which takes account of improving health and that sort of thing, people staying in their communities longer. I would suspect, personally, I would think that maybe that that trend might increase. We might get people staying in their own homes longer, but we'll see. They do seem to be very popular, and the way that they report them anyway, guys like companies like Ryman, they seem to be on a bit of an unstoppable upward curve still.
Indeed. And can we just very briefly refer to rural property? Still looking healthy, is it, Chris?
Yeah, it is. It's a bit of a mystery to a lot of us, I guess, because we've had the downturn in the dairying, but the prices do seem to be remaining fairly firm. They've come off a little bit on a monthly basis over the last couple of months, but not significantly. When I say they've come off a little bit, maybe in one or two areas, but in some of the most popular dairying areas, they still seem to be holding up. So, this dairy thing, if it's going to be a crash or a bubble, it's still yet to show up in property prices, which still seem quite firm.
Yeah. Well, we'll wrap it up there, but Sally Lindsay in Auckland, Chris Hutching in Christchurch, thanks for your contribution to Property Talk today.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To the SFO, 2 people have been charged with corruption and bribery by the Serious Fraud Office for allegedly receiving $26,500 to assist with immigration. Immigration New Zealand official Meng Yam Lim, 64, and his associate Kui Ling Pan, 64, appeared in the Auckland District Court today. Mr. Lim appeared on 4 charges of corruption and bribery by the SFO, while Ms. Pan appeared on 4 charges of being party to the same offences. They were remanded without plea until June 9. The SFO alleges Mr. Lim colluded with Ms. Pan between February and April 2013 to provide immigration assistance to 2 people after accepting $26,500. Mr. Lim was a border control officer with Immigration New Zealand, which first investigated allegations against him before referring the matter to the SFO. He had been based at Auckland International Airport as an immigration officer since 2008, where he would typically interview and verify passenger entry requirements to New Zealand. Ms. Pan had also worked at the airport. SFO Director Julie Reid says a public official's acceptance of bribes is a serious issue. She said New Zealand has low levels of corruption and bribery by international standards, and it's important that we maintain this good reputation by addressing those instances that do occur. She says Immigration New Zealand promptly referred the matter to the SFO following its internal investigation. Cooperation between government agencies in these matters is critical to ensure we prevent corruption from flourishing and to protect New Zealand's reputation as a safe place to invest and do business, according to SFO Director Julie Reid. To Kin.com. In the latest twist in the Kin.com legal saga, Crown Law is appealing a High Court judge's decision to release the internet entrepreneur's funds for living and legal expenses. Last month, Justice Patricia Courtney unfroze about $4.6 million in government bonds to fund Mr. .com's legal defence and for other living expenses, including his mansion's rent. It's understood some of that money has already been released to Mr. .com. A Crown Law spokeswoman says an appeal has just been filed, but no Court of Appeal date has been set. The case will go straight to the appeal court as leave is not required. The spokeswoman refused to say what the grounds of appeal are. Neither Mr. .com nor his legal team responded to NBR Radio's queries at press time, although the German giant labelled the Crown's action as a #starve-out strategy on Twitter. Separately, the Crown is attempting to register US forfeiture orders in New Zealand, which would have the effect of the Crown owning various assets as opposed to holding them frozen for Mr. .com. The judge in that case, Justice Rebecca Ellis, has reserved her decision. Meanwhile, Justice Sarah Katz ruled last month Mr. .com and his co-accused will face an extradition hearing no later than September 1.
NBR Radio, Tuesday the 19th. I'm John Stewart. A newly established annuities provider, Retirement Income Group, is equity crowdfunding before it targets retirees slipping into their KiwiSaver funds. I'm joined in the studio by Callida Smiley, who's our reporter covering that story. Callida, what does Retirement Income Group, the latest company to launch an equity crowdfunding campaign, actually do?
Well, it was actually co-founded by the former AXA and ACC Chief Executive Ralph Stewart. And it's gearing up to launch an annuities type balance fund product called the Lifetime Income Fund. And they're hoping this will take advantage of the large potential market, which is starting to happen as Kiwi savers reach 65 and can withdraw their savings. Now, most people, or many people, don't want to withdraw it in a lump sum because they're worried it's going to run out or they might blow it on a holiday. And so annuities could be an option because then they can put it in this fund and have a payout at a steady income over the rest of their lifetime.
So reassurance, really. Don't annuities have a bad reputation, though?
Yes, in the past they haven't worked so well because they've had a lack of inflation protection, they've been illiquid, and there's been some tax disincentives. This new product has addressed these bad things somewhat.
Yeah.
And currently there's no New Zealand providers of annuities, although they used to be offered through a number of life insurance providers. And the product is awaiting its final stamp of approval from the Reserve Bank.
Yeah, it's interesting you say that, that nobody's providing them at the moment. I haven't heard people talking about having annuities for years and years. Mm-hmm. So how much is it planning to crowdfund?
They're hoping to raise between $250,000 and $1.24 million at $1 a share, and they're crowdfunding on equities. There's only 3 days left to go because they're also running a wholesale funding round, which is apparently 65% funded already.
So any response yet, any idea yet how much they have managed to raise on the crowdfunding side?
Yes, I believe they've raised about 25%.
Well, they must be reasonably happy with that, are they?
Mm-hmm, I think so.
Yeah. Calida, thanks very much for that.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Tuesday the 19th. I'm John Stewart. The focus of the news this week is on the budget and the size of the deficit. One of the biggest contributors to the reduction in the budget deficit is the money not being spent on welfare. In his editor's insight on Tuesday, Neville Gibson says this is a success story you don't hear much about. Neville, why are you describing this as a success story?
Well, if you believe a lot of the talk around from the opposition, you think that the more the government's going to be spending on welfare, the better. But like the ACC reforms, where the fees are being cut all the time due to changes there, the savings in welfare benefits are a bit like a tax cut for all other taxpayers. And this has been drawn to my attention by a column in the Australian newspaper by Rick Morton, and he was praising New Zealand for the way that the benefit numbers have been reducing since 2012, and in his column he says that the people on benefits has fallen by 12%, and the calculations which he's drawn from New Zealand figures show that this is worth 650,000 years of benefit receipts over the next 5 decades.
Good heavens, that's an impressive number. So how is it possible?
Well, 2/3 of it has come from people who gain benefits, and one is the reduction in the time they spend on them from his analysis of the figures. And what this really means is that the future liability of welfare recipients has dropped from 86 billion down to 76 billion in 2003, falling even further to 69 billion last year. Now, there are some reasons like inflation, it's been taken out of the equation, but 2.2 billion of this came from just the sheer number of people on the benefits going off them.
Now, you say that he's analysed New Zealand figures. What figures are these? Well,
yesterday the Social Welfare Minister, Anne Tolley, brought out the latest, they call it the Benefit System Performance Report. And this isn't the figures that Mr Morton was doing, but they sort of base up his conclusions. Now, actuaries get to work on all this sort of thing and they extrapolate what's going on. But in the latest report, they say that 2.2 billion in savings is also accompanied by a drop in liability for sole parents of around about $3.3 billion. Now, Mrs. Tolley says this shows that there are 38,000 fewer people on benefits compared with 3 years ago, and the number of children in benefit-dependent households has fallen by almost 42,000 over the same period. Now, a lot of people probably say the government's cutting corners, but in fact it's quite a different story when you look at just how this is being achieved.
So how are they achieving this reduction?
Well, the government calls it the investment approach to reducing welfare dependence. It means that it's spending more money up front on each case, and it saves money in the long term through intensive management. This is very similar to what they achieved at the ACC. Now, the ministry believes the value gained from applying this approach could be put to work across the whole social sector. In fact, this is the same approach that the Productivity Commission reached a conclusion when it did social services delivery. That was a report they delivered a few weeks ago. And it says there should be a lot more coordination among the agencies and a lot more information on why certain people become welfare dependent.
Well, what can be done about that long-term dependency?
Well, when the Productivity Commission looked at this, it recommended that more be done by the private sector. It was interested in squeezing more juice or efficiencies out of the public sector. But it also raised the question of social impact bonds. Now, I didn't know much about these bonds when the Commission first brought it up, but we've now got the benefits of a report that came out last week from the local think tank, the New Zealand Initiative, that's the former Round Table. And it has also, there's a pilot running at the Ministry of Health. I'm not quite sure of the details of that. They haven't actually said so. But essentially these bonds raise money from the private sector, and there's a lot of foundations and private money interested in social programs. They contract to deliver social services, and if they reach the goals or exceed them, they get not just what the government was going to pay them for the contract, but they get a benefit on top. And so far these social impact bonds, which took off in United Kingdom in 2012, or was it 2010? Anyway, a few years ago, but they tackle specific areas like public safety, recidivism, rough sleeping, even at-risk children and asthma and that sort of thing. So this is maybe working out probably not quite as well in practice as in theory, but it's an experiment that's worth looking at.
Indeed it is. Neville, thanks very much for this Tuesday's Editor's Insight.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
In markets news, ASX-listed APD, or Asia Pacific Digital, has rebranded 5 of its subsidiaries across 6 different countries under its one brand, including Auckland-based Jericho Digital Communications. The Australian headquartered company is now pitching itself as a 360-degree digital services firm. Its offering encompasses digital strategy, performance marketing, customer relationship management, or CRM, e-commerce and analytics. APD has made a number of senior appointments as part of the rebrand, which is costing about $250,000. It has offices in Australia, New Zealand, China, Singapore, Philippines and Malaysia. Adman Paul Pritchard has been appointed as APD New Zealand Chief Executive, replacing Jericho Chief Executive Chris Lowther. Mr. Pritchard has a history in advertising, having worked most recently as Managing Director of Reactive and Digital Business Director at DDB New Zealand. The APD New Zealand business, formerly Jericho, specialised in CRM and email marketing through its marketing tool SmartMail Pro. The New Zealand office employs 20 people and has 170 clients, including Fonterra, Foodstuffs, Flight Centre, Mitre 10, Office Max, Resine and Positively Wellington. Mr. Pritchard was poached by APD to help transition the New Zealand business and says local clients have a big appetite for the broad new offering. He says the plan was always to build a full-service digital firm because clients found that when building their business using agencies and marketing companies, there was a lot of talk and spend of their marketing budget, but not a lot of accountability. The APD executive team's mission was to build a model that drove more accountability. But the rebrand is still in its early stages, and Mr. Pritchard says APD's clients are still being educated about its new services. Things don't change overnight, he said. He added the rebrand will enable a culture change across APD's many outposts. For the year ended 30 June 2014, APD New Zealand had revenue of $3.75 million and a net profit of $234.5-ish. $1,000, according to Companies Office records. APD's share price never quite recovered from the recession, having dropped from a high of $17.70 in 2007 to a low of 33 cents 2 years later. For the half year ended 31st December 2014, APD had revenue of $29 million and a loss of $4.2 million. Now a John Banks update. Former MP John Banks is not ruling anything in or anything out following his acquittal, including standing for the Auckland mayoralty, despite saying he's not sure any political party would want him. He will take legal advice about any further action or costs, but says there is no compensation for what he's been through. The Court of Appeal earlier today acquitted Mr Banks and ruled he should not be retried for allegedly filing a false electoral return. In April, the President of the Court of Appeal, Justice Ellen France, ordered a hearing on whether Mr Banks should be retried. She'd earlier ruled that he should be retried following the appeal court's quashing of his conviction for knowingly filing a false electoral return after disclosing donations from internet entrepreneur Kim.com as anonymous. Today, a Court of Appeal judgment from Justice France, Forrest Miller and John Wild has cancelled the retrial order and acquitted Mr Banks. In a press conference this afternoon, Mr Banks says he's been to hell and back over the past 3 years. He said, "Truth has prevailed at a huge cost to my family and with so much stress and so much oppression to myself." He said, crying, "You've got no idea how lonely this has been." Mr Banks says he will take legal advice about any recourse, but says money is not the issue, despite the process costing him enough to financially destroy a lesser person. He will not rule out standing for Auckland Mayor, but says a return to Parliament seems unlikely. Mr Banks called the Crown's withholding of evidence, as found by the Court of Appeal, to be a serious error of judgment. He said some of the mistakes made by the judiciary going through were outrageous. The Solicitor General has a lot to answer for, he said. He says the court action hasn't helped his marriage and that he regrets not being an MP this morning. But he rules out any court action against Mr.com, saying he wouldn't be bothered. The decision comes just weeks after Mr Banks' lawyer David Jones QC filed an application for the appeal court to recall its decision to retry Mr Banks after he received fresh material from the Crown about a contentious lunch at the .com mansion. In January, Crown Law said the evidence of two American businessmen who say they were present at Kim.com's mansion when Mr Banks and his wife were there needed to be tested in court. The appeal court found the evidence of new witnesses could have affected the outcome of the case. The businessmen said donations were not discussed at that lunch at Mr.com's mansion. Mr Banks says, "I can honestly say I haven't been back to the mansion for lunch."
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.